Monday was quiet. Too quiet after Friday's sell-off. And so the market decided to get totally chaotic, heck even psychotic, as the week has continued along. And after testing an equal low on Tuesday, and then blasting an hourly higher high on Wednesday, the competition of the timeframes is in full effect right now. And that tends to get pretty dangerous for traders if you don't recognize and adapt. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today with a closer look at the SPY daily timescale, and we'll begin by asking the question, what's going on here from a trend point of view? Of course, this is the highest high in the trend count. It's the all-time high, and it's very possible that this starts to emerge as a lower high. So let's actually label this with a P for potential lower high happening here. Now, what's going on with our lows? The last major daily higher low was this. Once the hourly trend actually flipped to down, we firmed up the soft FOMC higher low from over here. So on Friday's breakdown from last week, we know that there was a small overshoot, but for all intents and purposes, this was basically an equal low. And on the Tuesday session, we tested that equal low, and so far it's holding as support. So on the daily timescale, I'm not able to say yet that the daily trend is definitively down. We have a possible lower high here, but it's not a definitive lower high. The other thing that I would just say is if the market was going to be more bearish, then Monday and Tuesday's highs, these two equal highs right here, at the daily 20 SMA, mind you, should have yielded a much cleaner lower high, which would have been well underneath this overhead consolidation period from back here the week prior. And that just simply didn't happen. On today's session, right, Wednesday, the market did make an attempt, although very short-lived in the morning, it made an attempt higher before falling back down into this balance. So on the daily timescale, and as I mentioned in the intro, we're playing competition of the timeframes when it comes to trend. The trend right now, I would say, is actually neutral on the daily timescale. Ideally, buyers would have stayed here for a higher low, and that just simply didn't happen, so we can't remain bullish. And it's also not true that we have an equal high. You could see that this is still, as we said, a potential lower high. So that threat still exists, and it's a diminished threat just because we did not hold the daily 20 as resistance cleanly during today's Wednesday session. So the trend here is somewhat neutral. It's not definitively down. What would cause me to say that the trend is flipping down? It would, of course, be the next component of a trend reversal, which would be the lower low. If we actually break this for a lower low, and now we would have a high, a lower high, and pattern traders can rejoice, right? Here's your left shoulder, there's the head, there's the right shoulder. If we break the neckline and bring in a lower low, the daily trend will definitively flip to down. But until that actually happens, I cannot say that the daily trend is down. Once again, we've explicitly walked through why this is the case. Now, the reason that this market isn't so straightforward, though, is because if we take a look at the hourly time scale and just drop it immediately here, you could start to see that if this was going to be now an hourly double bottom, and we could start counting hourly trend, right? If this marks a major low, this is an equal low on Tuesday's low of day test. This is a high, this is an equal high. Now suddenly we actually have an hourly higher high. Where would have been the ideal hourly higher low if the market was going to remain bullish? Ideally, it would have been over the double bottom neckline and that daily 20 SMA. So in a picture perfect scenario, the market would have done something that looked like this. We would have had low, this would have been a higher low into the close on Tuesday, and a higher low over the double bottom neckline would have maintained the most optimal bullish configuration on the hourly timescale. But that also is not the case in front of us. We can clearly see the overshoot back down to an equal low that was set here to the pullback low from Tuesday. And where have we closed? Right back at that magic level, the high of day from both Monday and Tuesday, the daily 20 SMA, and now, if we take this one step further, what's the issue, right? Well, in theory, could this not now yield an hourly lower high, and now we're in an hourly downtrend? That is possible. Let's talk about what also has not happened here. The market opened on a gap down on Tuesday morning. In theory, if stronger sellers were going to participate in this market, they should have used Monday's low as a potential reversal point. Gap fill reversal is a classic trade setup, right? So even if you made the equal low here first and then rallied to test the low of Monday's session, in a picture-perfect world, the hourly trend remaining down and then really pressuring the daily trend to flip to down as well would have looked like this. You would have then had high. This would have been a lower high on Monday, lower high under Monday's low on Tuesday, and then an equal low would have really opened the door for the full-blown daily trend reversal out of an hourly downtrend that has been established. And that, of course, was not the case. We did not get this lower high on Tuesday's session. And now you could say the same thing, and we just kind of walked through it, that the ideal situation for buyers would have been the higher low over here. So as we've clearly illustrated, the market is not trending. The market trend is neutral as of right now, and we have the competition of the time frames. Is the hourly chart going to try to hold up and say that these are equal lows on the hourly and this is the highest high? Can we find some sort of movement that looks like this? And that would start to put the pressure on the thesis that this is going to sustain as a daily lower high. Let's put P here for potential so far. The other configuration is that the market fades back down to here, sets an hourly lower low underneath this area, confirms via lower high, and now all of a sudden this will be a lower high on the daily firmly. Okay, so that's the configuration I'm seeing currently. Now, what's the bottom line across all of this? There's a couple of things, right? Number one is that obviously the market is extremely volatile right now, and it's rocking and rolling in both directions. So as traders, you cannot be married anymore to a bias, directionally that is, when the market is in a neutral trend with extreme bouts of volatility. So number one, keep an open mind to trading both directions in this market. Number two, probably don't confirm a daily trend reversal or continuation in the upward direction until the market does something incredibly clear, which would just be make a new daily higher high or make a new daily lower low. That is it. Until either of those two things happen, I would maintain the stance that the daily timescale is really more so in a neutral trend, more so than anything else. Once again, keeping an open mind to trading both directions on the tape, both longs and shorts, with equal amount of bias towards both, and not getting married to one particular direction. Now, with volatility rocking and rolling, we also likely want to widen up our stops and then also, therefore, increase the targets. The ranges that we're traveling here are much wider. So you're not going to be able to get away with, in the ES futures, a 2-point stop loss right now. Maybe if you're using order flow and you pinpoint some particular level or something of the sorts, but if you're using candles to set the width of the candle as your stop interval, you're probably not dealing with a 2-point stop. You're probably talking about an 8-point stop, 10-point stop, 15-point stop in the S&P futures. Never even mind the NASDAQ, really wild west over there. So widening stops, accommodating volatility, and likely, to solve for that, lowering your position size. So as of right now, in this market, yes, we're whipsawing back and forth. There's plenty of opportunity to trade this on the intraday, but to trade it responsibly, those are the key takeaways when we're dealing with a neutral trend. Now, if I had to make some assessments here as to what may happen next, I do find it quite compelling that the sellers were unable to pile in after the momentum from Friday. Now, there's a couple of reasons why this is somewhat understandable. If we've learned anything from April, it's perhaps that we're going to walk back all of the China escalations and things might get better from a news flow perspective. That's one situation. So the fact that sellers could not materialize this gap down here, I'm leaning into that considering that Friday was really the shifting in tone. If we think about the really high time frames, and I'll just do this as, for the sake of exercise here today, if we go to the weekly chart, right, we know that there really hasn't been any change in the weekly trend. So if I'm trying to forecast, okay, what is really going on behind the scenes or what's going on with the underpinnings of the market, we're still overall in a bullish trend here, and the sellers seem to be the ones who have failed to do anything meaningful with the change from the status quo. When we're in a bullish environment, how many times do I say it's bullish until proven otherwise? The sellers have to convince me that we are going to change the status quo, and then I will become more of a bear. That's the situation that I'm seeing currently, with the competition of the timeframes between the daily, the hourly, and how to ultimately, what action to take because of that. Again, we walked through it, but loosening up the stops, lowering position size, not marrying a bias, not saying, oh, I'm going to prove the market right. It's got to crash and burn. Everything's going to zero. And then also not being the guy who says, oh, markets only go up. We have to go and trade a brand new all-time high. Both of those biases in this current environment will get you absolutely wrecked when it comes to intraday trading and trying to stay on the right side of the trade. So with that, let's get back down to the hourly. Let's come in here with a little bit of pathing, and we'll start to make some assessments. If the market tomorrow can get some kind of a bid underneath it, I would remain incredibly cautious in this zone here between 665.25, 667.25. I just don't think it's worth having an overwhelming bias. Why? Well, because we're technically over the Monday high, the Tuesday high, the daily 20 SMA. That's helpful, but we're still underneath this overhead supply here, and it's still possible that this lower high is going to persist. So in between this zone, I would still remain neutral. If we were to get a Brigade bolt over 667.25, that's where I'd become a little bit more bullish, and then definitely bullish on the recapture up and over today's Wednesday high at 669.65. So this path is sort of required for upside. A situation that I would also be prepared for, because we're not really trending, this is a trending outcome that we've just drawn, you have to keep an equal or an equally open mind to something that is a possible look above and fail, right? If this is going to go look above and fail, right, and then now this to this is a lower high, and we're back inside of this range, I would be equally as okay with an outcome that looks like this. I'm not married, biased direction-wise to any particular outcome here. And this lower high would be tradable underneath 665.25 to rotate all the way back down to the range low at 660.40, right? That's one situation as well. So far we've gone consolidation neutral bias. Brigade bolt here gets a little bit more bullish, definitely bullish over Wednesday's high. If we go look above and fail, this is acceptable for a range rotation. If the market just drops out of the open, I would not want to get tangled up in the midpoint of this range. I would avoid that situation. I would also keep an open mind to a range low bounce, just as we saw today. And I know it's going to look like anything can happen in the market. And guess what? In a situation like we're dealing with right now, that's actually the reality, right? We could bounce off the bottom end of support. The other thing, of course, is that we could break and Brigade bolt underneath support, and now we're starting to look at a daily lower high, and that would definitely be a cue if the market were to start spending more time, and I'll just give you the level here as the level of importance. If the market were to start spending more time under 660.40, the daily lower high threat is definitely a reality that I would pay attention to. Any consolidation down here is bearish for that head and shoulders on the daily we were just talking about. And of course, that all starts to trigger and really change the daily trend on a failure at the daily 50 SMA, which is the blue moving average down here, and underneath 654, which is the FOMC low and the equal low that was followed up when the hourly trend did flip to down. So once again, I understand that this looks like, okay, you're just saying anything can happen. But there's an edge in understanding that anything can happen and being very open-minded to a wide variety of outcomes here as a trader when you do not have a daily trend and when the hourly is kind of at odds with that daily chart as well. So that's what I've got for you on the intraday here for the S&P. I would continue to monitor these key levels. I would be very open-minded to the lower high thesis possibly playing out, but I would be equally as open-minded to everybody saying, you know what, this is kind of one of those taco situations again. We're going to de-escalate with China. Things will be fine. If the market proves it via these higher lows, especially this one up here, then yes, we will trade those bullish outcomes and we'll get right back on the bullish side of the market there. I do want to come in here with some Fibonacci's and just quickly measure from the all-time high to, well, it's still just Friday's range. It really hasn't changed here. It's reinforcing everything we just talked about, right? Right now, the market's technically trying to resolve no man's land, which is between the 61.8 and the 38.2. There's really no reason to be an aggressive bull at the midpoint of a big range. Again, that's that character change on Friday. It just doesn't make sense. That's reinforcing the levels we just had. We can also come in here with our anchored VWAPs on the intraday. And just notice, right, if you take a look at this, technically these anchored VWAP clusters, which come from, this was the major daily high or low, right? This was the prior higher high before the all-time high. That is confluence at 665.25. Friday's anchored VWAP has actually been recaptured already, and Tuesday's anchored VWAP from the gap down has also been recaptured into the close on Wednesday. So does it make a ton of sense to be a big aggressive mega bear when hypothetically we're doing okay on an average price point perspective? Probably not, which is why in here I'd be a little bit more neutral to bullish, a little bit more neutral to bullish, and definitely bullish over the top end. You're over the anchored VWAP stack. So that's what we have here at the price point level. Let's get into the market internals though and take a look under the hood here. If you're not familiar with the market internals, check out the video tutorial in the top right hand corner on how to set this up, what it all means. For the most part, we want to write off what happened on Monday. Why? Just because Friday's close was so disconnected from all of the price action on Monday, of course it's going to read inherently bullish. Remember, this measures from previous day's close, this measures from previous day's close, this measures tick by tick data. So you can actually see here that Monday's cumulative tick, it really wasn't all that strong. I mean, this is a 1600 into the close. A strong build is 5,000 positive or negative. It just wasn't even close. So Monday, very neutral, very balanced. I would not read into the volume inflows or the advanced decline line here. Where we start to normalize is the gap down follow-up on Tuesday. This is where sellers had an opportunity, and we talked about this a little bit. In my view, leaning back into the weekly time frame, the sellers have the burden of proof. On Tuesday, the sellers could have, on the gap down, especially on a gap fill reversal, they could have built out an advanced decline line that was much more bearish underneath negative 1500. That didn't happen. You can clearly see that the market advanced decline line trended higher and closed positive. You can clearly see that in the morning session, when we were still underneath that Monday low, there was a flat cumulative build. There was an opportunity to build bearish into the close. It did not happen. There was an opportunity today, even as the market was selling off, to really flip the internals on the bear side. What happened here? No proof from the sellers volume flow wise. No proof from the sellers advanced decline line wise. Yes, an intraday trend lower, but still net positive on the session. And you can even see here the cumulative build closes flat. So all things considered, the amount of momentum that happened intraday on the two big legs to the downside had no follow-up at the exchange level. And therefore, as we peel back the layers of the onion, it seems to me a little bit, keyword a little bit, I'm not over-indexing on this any more than I need to, a little bit more bullish than it seems bearish. Now, I'm keeping an open mind to that bear downside outcome should we get look above and fail. This is not an overwhelming display of bullish evidence, but it's not as bearish as you might think. It's not, oh my God, Armageddon sell, everything's going to go to zero. That's not the situation that we're seeing at the exchange level. Let's check in with our market profile. What about the profile? Where is value? I think this was, to me, one of the more bullish reasons coming into the Wednesday session looking for upside was that on the breakdown from Tuesday, you could see that there is zero build out of value area down here. The value area is completely overlapping the Monday range. If I just draw in Monday's range, here is Tuesday's value area, and the point of control is actually over Monday's high. If we had stronger sellers participating in this market, once again, the burden of proof is on the sellers. This is a change in character. Follow it up with something, por favor. If the market's going to fall apart, you should have seen value build out lower. You should have seen value cling to the point of control from Friday. You should have seen the market try to spend more time and get more acceptance in the spike from M period on Friday's close. And it just simply hasn't done that. Now, on today's session, although there was that big reversal midday, two legs to the downside, what do we see in H period? H period has great excess on the low. You can see that there's a nice taper here in terms of the shape of the profile. You can see that value area, even with that big breakdown, is actually overlapping to up from Tuesday's session. Once again, another layer of the onion peeled back. Is it as bearish as it might seem? Although there's crazy whipsaws intraday and there's a lot of volatility. As we said, the market's getting a little psychotic. I mean, yeah, there's volatility, but it doesn't really look all that bearish in terms of the intraday action getting follow-up from the sellers. And now that doesn't mean that there's no money to be made shorting the market. Of course, there's boatloads of money to be made if you were short the market for this move today. But in aggregate, the data points do not lean aggressively bearish based on what we see here. What would have me change my tone? Probably price acceptance underneath Monday's low, right? 66.60s. If we take that out and we get more acceptance down there, if the value starts to build underneath that, yeah, I'll change my tone more bearish. Am I open-minded to that being a possibility? Of course. But for now, it's not the chart that we have in front of us. Let's go back on over to the platform here. Now that we've covered that in such great detail, we could probably be a little bit quicker through the QQQ, the NASDAQ, the Russell, the whole nine yards, because it's going to be very similar. So you could see here the competition of the daily trend, right? There's no change there. Here's the highest high. Here's a potential lower high. Here's a low. Here's a much more equal low. You did not overshoot as aggressively on the Friday breakdown last week in the NASDAQ. You can see Tuesday's low is slightly higher. You can see today's low right here at the Monday low. Monday's that little inside bar. Notice that we've closed over the daily 20, but we still have that two-day equal high from Monday and Tuesday. So competition of the timeframes still in effect. Is this still a possible lower high? Of course. Is this still a threat? Of course, this is a threat. Once again, when and if we break the neckline, when and if we have a lower low, I will change my tone on the daily chart, but we just don't have that yet. If we take it on down to the hourly chart, you can see here, there's really no reason to get involved in what we dub the boredom box, although what I'm really starting to like to call these things is just the junk drawer, right? This is the junk drawer. We've got a junk drawer on Tesla, a junk drawer on Palantir. There's a number of these ranges that we'll talk about today, but the boredom box, the junk drawer, I would not be aggressively biased in between 602.65 and 596.75. In this area, anything goes. If we're getting acceptance above, guess what? This is actually one step better than the S&P. If the market's finding acceptance over 602.65, it's actually accepting inside of this range versus if I quickly flip to the S&P, see how this two-day high from Monday and Tuesday is underneath the overhead range? For that reason, there's a little bit more, believe it or not, of a bullish edge to have here In the NASDAQ, should we find acceptance over 602.65 for that exact reason, right? You're already getting acceptance in that upper range rather than being able to use it as overhead supply to act as resistance. So 602.65, your general pathing is going to look very similar to the S&P 500. It looks like right now in the after hours, we're trading 603.49 by, let's call it 603.50s. If 603.50s is here, pullbacks tomorrow morning that support 602.65, target today's high. Brigade bolts through that, target the all-time high. If we look back into the range and fail via a lower high, it's very possible that you could look for the bottom end of the range as a quick short, risk, reward, right? Targeting 596.75. Is that the best idea? I don't think it's the best idea. I think we should remain open-minded to it. But as we've seen, slight edge to the bulls as of right now. If we get to the bottom end of this range, I think this is a reasonable take, support off the bottom end. And if we get this Brigade bolt underneath 596.75, we'll be a little bit more biased to the downside, and ultimately that daily head and shoulders. So it's the same configuration ultimately as the S&P, with the subtle difference of the bottom end of this overhead supply already being possibly recaptured depending on tomorrow's open if these after hours rallies can stick. Let's take out the Fibonacci's real quick and we'll get a sense for where we are from that perspective from here to here. We are at basically the 61.8. It's loose confluence with no man's land, the junk drawer over here. If we come in here from a anchored view app perspective, let's quickly take a peek at these. We're above the entirety of the stack. And again, a gap up open, not a true gap out of range, but an open disjointed from today's close would leave us above those anchored view apps as well. You could probably start to build a more bearish argument if you take out this level in here, which is loosely the equivalent of about 24.9 if you've been tracking on the NQ futures. 24.9 is that sort of intermediate support. It's the morning low, it's this afternoon low, it's the consolidation from the Monday afternoon, sort of balance, if you will. So 24.9, if we really had to put a level to it on the futures, or excuse me, the cash market, I'd probably say something like 601 flat. 601 flat in here could be an added level. I'm not going to get too level happy because what I just generally want to remind myself, remember, a chart should always seek or serve you. A chart should serve you. A chart is not like, oh, is the level right? Is it this? Is it that? There's a right and wrong way to draw levels, but generally, if your chart leads you to more questions than answers, you got to work on your charting, right? So I want to remind myself that in this range, there's really not a heck of a lot to do. If I have a key level in there, I'm going to think, oh, there's a good opportunity in here if I'm penciled in and like really drilled into a 2-minute chart or something like that, 5-minute chart. So I'm going to leave that blank for now, but those are the key levels. That's how I'm looking at this market. Those are the numbers. Those are the anchored view apps, 20 SMA, whole 9 yards. Let's get into the internals for the NASDAQ side of things. And what we'll see here is very similar. Once again, no follow-up on Monday or Tuesday from the sell side on Friday. You could see Tuesday's builds in the upward direction, volume inflows, advanced decline line strong. Same thing with the cumulative over here, building strong into the close. Today's session, even with those two legs to the downside, advanced decline line remains positive, volume flows remain positive, and even the cumulative tick remains fairly flat, which is somewhat surprising considering we did slam. I mean, the low tick of the day today, close to negative 1,500 in the tick Q, that's pretty aggressive. So burden of proof being on the sellers, they have not met an overwhelming amount of proof to have me change my tone here at the exchange level. Let's come into the market profile for the NQ side of things and just give this a little reset. We're going to see a lot of the similar concepts as the ES, so I won't break it down in as much detail. I will call out, though, extremely poor high on the BCD period at the top. Because these ranges have gotten pretty wide, if we zoom in, we might get a little bit of excess, but not much. Really not much in that C period there. Once again, value area point of control higher even relative to that Tuesday breakdown over here. It did not drift on Tuesday underneath Monday's range. Same indications. And by the way, if you're not familiar with market profile, I don't know if I pointed at it before, but there's a video tutorial in the top right-hand corner. Let's jump back on over, over to the platform here and take a look at everybody's long-lost cousins, third removed brothers, Goldfish. The IWM, the small caps, Russell 2000. Not many people trade it, but it's a great bellwether gauge for the market. What do we see? I mean, just total dominance in terms of small caps performing extremely well on the follow-up to the Friday breakdown. Now, I would say a lot of this has to do with what? Jerome Powell's commentary on the Tuesday session. We had Mirren today as well, speaking quite dovishly. Even Waller was speaking somewhat dovishly. So with the idea of rate cuts continuing, an easing cycle continuing, small caps, like that quite a bit. We're clearly over Friday's breakdown high that was recaptured on Tuesday. Tuesday smashes Monday's high. Tuesday also breaks up and over the upper edge of the weekly expected move. It breaks us out into a brand new all-time high. And on today's session, you can actually see for the most part an attempt to stay over that previous all-time high level at 248. So are we bullish on small caps? As of right now, survey says yes, the trend is up, and this is going to be a helping hand for the S&P 500. And what does this mean? Why is this important? Why do we cover this? Well, what did we talk about in the SPY? Does it make an overwhelming amount of sense to be bearish here? Probably not. Is this supporting the bears or sort of taking away from the bears, supporting the bulls? Right, this is supporting the bulls. We even have evidence in small caps. So the broadening nature of the market rally is going to be bullish for the S&P 500, and it's going to prevent an outright Armageddon sell where the S&P loses 10% in 2 trading sessions. Now, if that happens, you're going to need small caps moving down aggressively, but we have not seen that character trait with the recapture of Friday's high. As of now on the hourly chart, you can clearly see that there is no competition of the time frames here. Instead, you have an hourly uptrend with lows. This marks a higher low. This marks a higher low into the afternoon. We had highs. Monday technically had a lower high, but Tuesday blasts it for a higher high. In today's session, we get another higher high. So we're in an hourly uptrend here on small caps. If we could stay over 248, it's an hourly bull flag. We look for continuation. That's a blue sky breakout. What else is this? Well, it's a weekly breakout of a huge multi-year balance, right? It's also worth calling out. Wow, it's kind of unbelievable that we need this large of a chart to look at this range. It feels like just yesterday, 2021. That's wild. Anyways, there's your range high. You're getting a weekly breakout through the top end of that as this market continues to evolve on smalls with an easing cycle. So as we think back to the S&P 500, as we think back to, okay, what's the idea here? Remain open-minded to both sides of the trade. Remain open-minded to volatility, but overwhelmingly bearish? I don't think so. Let's take a look at the Russell on the internal side. You can see the strong volume inflows, right, creeping in. I wouldn't say over the key level, but still in. Definitely better on the Tuesday session. Today's the same as the NASDAQ, basically a rinse and repeat of the NASDAQ at the exchange level. It does not look like there's an overwhelming, compelling amount of bear evidence here to have me change my tone, especially if the hourly trend is up on smalls. Let's quickly take a peek at our market profile and just make sure that there's no issues with value and where we're progressing over here. And survey says no. On Tuesday's session, value higher. On today's session, overlapping to up. Great excess in H period low. There's actually decent excess in B period high as well. So is this auction a little bit more healthy? I would think the answer is yes. Once again, not an overwhelming amount of bearish evidence there. Let's get back on over to the platform in Thinkorswim and take a tour through our S&P sectors, because it's not all rainbows and butterflies. Again, there's a small edge to the bulls, but again, open-minded to both directions. I think if we take a look through the sectors, we'll see a little bit of a different picture here. Now, what is that picture? It's the sector posture. It's really not all that bullish, right? As this market rebounds back in the upward direction, what are the sectors that are leading for the week? You could see it's real estate. That's an incredibly lightweight sector. It's rate sensitive, but it's lightweight. Utilities, lightweight, also rate sensitive and defensive. Consumer staples, lightweight and defensive, right? So posture here is more risk off as compared to risk on. At the bottom end of the barrel, the bottom three are going to be your XLK, the only red performer for the week. That's your heaviest weight risk on sector. That doesn't look great as the market's trying to rally back here, right? TLT is not really a sector. It's just the bond market there. But then we have energy, lightweight sector, and then the XLV. It's now lighter weight, and it's also defensive. So posture's not Armageddon, and it's not full-blown risk off, but it's also not bullish. So that concession there probably keeps us more open-minded as opposed to over-indexing on the bull data points that we've seen so far. No comment on real estate midpoint of the range. If we look at utilities blasting a new all-time high, that's got to be a little bit of a warning sign for the market as it's trying to attempt a reversal back to the upside off of Friday's volatility. The key ingredient here would be if utilities break down and pull back, which is totally reasonable from a trend following perspective, you better see the XLK pick up the slack. If it doesn't, then now we have issues, and you're probably dealing with a deeper pullback again in the S&P with the hourly trend threatening a reversal to the downside, and the daily chart probably sitting right on the equal lows of the neckline, threatening a breakdown as well. This is if utilities breaks down, if these big outperformers break down, and we start to see tech not picking up the slack. Okay, so understand that from a rotation thesis perspective. Here's the XLP breaking the range to the upside, but what's the issue? You've got this massive overhead supply here at 80. If this rejects for a weekly lower high there and rolls over, and once again tech does not pick up the slack, that's a situation where we probably lean a little bit more bearish in the S&P. So you can see it's not picture perfect. There are cracks in the armor to this market right now, but these are the things that I'm paying attention to. You can see discretionary on the double top right over here. We're underneath the neckline, possible lower high. That doesn't look great. This is a heavier weight risk on sector for the market. If we look at communications, You can see your double top. We've been under the neckline for a while. This is a counter trend rally in the context of a developing daily downtrend. No longer as good. Now, of course, could we say that the weekly still has a higher low here? Sure. Weekly chart has a higher low, that's fine, but I would need a daily trend reversal to get fully back on board the bull side, which probably looks something like this. Lows, higher lows. Okay, now we have a reversal. We're not there yet. Let's take a look at financials. Decent on earnings, snapping back into this range here, but ultimately just in the range. I can't really say anything overwhelmingly bullish about it until we get over the top end of the range and invalidate what is still currently a little bit of a head and shoulders. Could we not still set a lower high here? Of course we could. Of course we could. Let's go SMH. Semiconductors, it's still in the range here. I'll give this the benefit of the doubt. If this wants to consolidate and then Brigade bolt into new highs, bullish. I will give the market the benefit of the doubt on that one. This consolidation does still look good, and I do like the hold of today's low back inside of the range after Friday's aggressive breakdown. Bullish there. Let's go industrials, just inside the balance range here, no comment. Materials inside the range here, no comment. Let's take a look at healthcare. Still a mild pullback in the context of this big breakout. So if this can catch for support and rally, it might dampen any impact in the S&P 500. I would be more concerned about this if it continues to pull back and does not hold 138.75. So that's still the big watch there in healthcare. Energy, still inside the range, no new pivot low, although we are underneath these pivots in here. Small bearish data point trend-wise and pressure-wise for the market, but probably a non-issue when it comes to inflation. Let's quickly go over to crude. We've been tracking this argument. Crude, really want to see, like, I know you don't want higher prices at the pump, but globally it's better if we're here from a growth and demand perspective. So I'd prefer that oil does not continue its slump aggressively. Balance sideways, okay. This, maybe, if we can kind of cling to about $60 a barrel, that's about the equilibrium for crude. Where we would say, okay, we're going to avoid that recession narrative becoming too loud, too noisy. If we take a look at the bond market, it's continuing to move higher here as rates continue to drift lower. Rates moving lower as well, not only from the commentary of Powell, but you got to start thinking about the labor market. Do they know something we don't? I mean, obviously we're in the dark right now with the data. Maybe the Fed already has these reports. Maybe they don't. I'm not going to play that game. But the market's clearly still concerned about the labor situation and somewhat less concerned about inflation. If we do have a recession, where do corporate earnings come from, right? It's always going to start with the labor market. And right now, the market is saying that the bond market, the interest rate market, is saying you need to continue easing, right? It's a good thing Jerome Powell did acknowledge that in his sort of conversation on Tuesday. If we take a look at the XLK, this is the most important sector for the market. As long as we're over these lows, I can't become an outright bear. I can be neutral in here. I can lean bearish. I can certainly talk and see the lower high in here. But until we actually break that level, can't quite convince me that the S&P is going to crash and burn. If we're holding up over this zone, it's about $1 wide at 280 to 279. Let's quickly take a look at our sector ratios and see what's going on from this point of view. If you're not familiar with how to set these up in Thinkorswim, check out the video tutorial in the top right. You can see that this is still the glue. And I know it sounds like a broken record, but XLK, because it's basically, let's call it 35%. It's 35% of the S&P 500. If this is pointing up, it's going to be very hard for the market to just outright collapse, right? XLF still needs some work, but we talked about the structural chart being in balance. This looks a little bit more neutral. I would say that a lower high is still possible. That's a threat. This definitely looks a little bit more bearish, already curling for a lower high on today's session in discretionary. This is kind of cooling off a little bit, not full-blown risk off. This is an issue out of utilities, and this still is kind of okay on staples. I know staples is a decent performer here on the weekly, and yes, it's up off the lows, but still net, it is in a downtrend, and therefore, I can't really take my posture to full-blown risk off, but I can certainly neutralize it, right? I'm with you on neutralization rather than outright, everything's fine and dandy. No, it's not fine and dandy. If we take a look at this, certainly a threat of a lower high happening here. This is already in a downtrend. That's an issue. This looks okay. Excuse me. Let's put some X's and checks. Let's go check mark here. This is kind of neutral. This still gets a check, and I go neutral on this. So once again, you're not really batting 6 for 6. All is in the clear. It's a little bit more balanced than that, and I think it would be irresponsible to not acknowledge that, right? Let's go to the B set. Gold continues to be an absolute monster to the upside. I am still looking at another gold capitulation short at some point. It played beautifully on this session. We'll see if we get it again at some point. The gap and goes. We want it to blow off, and then we strike when things are just so overheated on gold like this gap up day over here. So we'll see if it resets, but as of right now, I don't think I would do it tomorrow. We don't have that missing ingredient of volume. Let's jump on back to the ratios and just continue to point out that the TLT ratio, it's still over the daily 50. That's a small red flag for the market. Once again, although the S&P at its, sort of price point level, at the internals level, at the market profile level is bullish, the intermarket relationships are not all there in terms of everything being in the clear. If you look at Bitcoin, it's breaking down slightly back down towards the bottom end of the range. That would be a risk-off indication. If we take a look at our dollar and rates, speaking of gold, Bitcoin, the whole 9 yards, dollar coming in is bullish for gold. So if we're going to take that gold short, you probably need this breakout happening on the dollar, which would mean that you probably want to see rates bounce off of 4% a little bit more meaningfully, and we don't want to see the super dove, Mirren, continue to batter the newswire with continued comments about lower rates. Although he did acknowledge that the neutral rate might be slightly higher than he originally forecasted. He was thinking 0, which the market didn't like so much. Anyways, that is the Dixie and rates. Let's jump into where do we want to go from here? Let's go inverted ZT. Let's talk Fed for a second. So just continuing to probably indicate that the odds are 90%, 97% for that cut in October. I haven't refreshed this since the morning, so let's give that a little refresh. Probabilities table, 97.8%. There you have it, unchanged on the actual probabilities. And you can continue to see that the market is pricing in all the way down to 275 by 300 rather than just 300 by 325. This is dovish, or at least the market's expectation is that we will have a more dovish Fed as we continue to get cuts through this cycle to help out the labor market. There's really not much to talk about on the economic calendar here, just noting that all of this data is going to get postponed. You'll continue to get the talking heads tomorrow from the Fed, more super dove, Mirren, tomorrow at 9 o'clock Eastern. We'll be live on the pre-market prep for that, of course. And then Mirren again, 4:15 market will be closed at that point. So not much to pay attention to economic calendar-wise. If you look at the earnings calendar, this is worth paying attention to. TSM tomorrow morning will continue to set the tone for semiconductors through the earnings season. ASML had a beautiful gap up this morning, although it did fade. The gap up certainly pressured some early morning setups in the upward direction. So please keep an open mind to TSM lifting things like MU, NVIDIA, Broadcom, AMD, all those guys. Possible some sympathy there from TSM earnings tomorrow morning. Aside from that, maybe Amex into the close, see what the state of the more affluent consumer is looking like based on their models. But for now, I'd say TSM is really going to take the cake for the rest of this week. From there, next week we'll continue to get heavy in terms of earnings and more information coming out. Let's get back over to the platform. Let's take a look through our supporting evidence categories and let's keep this thing moving along. The bond market today continues to just show us the same things. More concerned about the labor situation, not concerned about inflation. As we take a look at the credit spread market, you could see the rollover happening here actually leans a little bit more risk on for the marketplace in the S&P or just generally in equities. If we take a look at junk bonds, they are continuing to fight back from their bearish divergence. The way I would sort of illustrate this is if we just zoom in, so these are equal. There we go. Just notice how this is the LQD on the bottom actually, but notice this. You could sort of point out this higher high from here to here. We could also come in here from this to this just to get a sense for the way that these highs are aligned, right? So now let's come in with the SPX and see the same zoom, and we'll just do some general comparisons of the two. So if you take this high, right, you're still divergent from here to here. But the point is that the S&P has the lower high, but this has a higher high in the junk bond market. Just like this was divergent on this particular relationship, you can see how the S&P had the higher high here, HYG had the lower high. That bearish divergence, I don't want to say it led the market crash to be a thing in the first place, but this has usually been a canary in the coal mine. The fact that the HYG actually has a bullish divergence to the S&P down here, that's kind of telling. It's something that I would definitely pay attention to as the market continues to evolve. As we take a look through some additional supporting evidence, let's get into breadth. You'll notice that there was a sharp rebound out of new highs versus lows. Even the 50 SMA, 200 SMA charts got a sharp rebound. I would prefer that this got over the 50% mark sooner rather than later. I like how this was a short stay, basically a day or two at max is what you want to spend under the zero line if you're going to sustain continued upside pressure. You start spending more time under that and things get tumultuous. This was basically the reversal in the early stages of the year, right? When there was consecutively more new lows versus new highs for a sustained period of basically at that point months, right? And forget about April and the tariff debacle. So you just want to see a short stay underneath, just like over here. You want to see a short stay underneath. You want to see stability above. The more time you start spending underneath, the more deterioration there is underneath the hood. We can go check in on the RSP, which is the equal weight S&P index. Notice how we're still inside of this balance. If we break out of it, that would be bullish. If we break down from it, that would be bearish. Taking this one day at a time, as of right now, no big indication, a little bit more neutral than anything else. If we look at the equal weight NASDAQ, it's actually recaptured this level from back here, which to me is slightly more bullish than it is bearish. I think this makes sense considering the configuration that we saw of the NASDAQ relative to the S&P with that overhead supply. If we jump into the volatility side of metrics, I'm primarily waiting to see if we get back down underneath 1850. If we do, I think we're, I don't want to say in the clear, but in a better situation for continuation back up towards the highs in the S&P. As of right now, things do remain elevated, which makes sense considering the amount of intraday back and forth that we've been seeing. If we take a look at the VVIX, I'm sure it will remain elevated also. If this breaks out, that would be a red flag, and I would be even more open-minded to. So actually what we can do, I'd like to do this now before I forget. Let's throw an alert on that at or above about 120. There we go. Will be interesting. If this triggers tomorrow, I would want the heads up, and I would probably detach myself from becoming overly bullish and, again, really neutralize and just say anything goes, right? As of right now, I think there's a small bullish edge. I've sort of put that thesis forth. You could call me the perma bull of YouTube, whatever. I think it's just clear in the data points. But if that VVIX triggers, I would be just sort of neutralizing back down to flat, right? Let's take a look at the volatility futures. Still in a decent, in the back end of the curve, a decent contango, but not really in the front. You can see over here, oops, zoom, there we go, on the 9 versus 30, not bad, still in a contango. And the one-day VIX, it's still elevated. Still elevated. This gap down this morning was not quite low enough to neutralize back down into what I would consider normal situations at a VIX one day. So that is the look through the supporting evidence. I think we should get this show continuing to move forward. We should get this thing moving along. Let's jump into the core list of companies, and then we'll take a look through those 3 additional ideas. So NVIDIA is a small concern I have here, especially with the ASML earnings gap up move. It's failing this daily breakout level, which is a big deal. The fact that NVIDIA cannot go Brigade bolt higher low over the level, the fact that it's back in this range, starts to look more like look above and fail than anything else. And for that reason, being the heaviest weight component of the S&P 500, I would definitely just kind of make note of this failure. Any consolidation that persists here and starts to drop that daily 50 SMA, yikes, that's really not looking compelling for the S&P 500 coming out of this route with any more meaningful rotation or like, what should I say, a bullish posture rather. And I think this ties back to the conversation we had with the sector posture, right? What was leading today? It certainly wasn't tech. It certainly wasn't semiconductors. Those weren't the leaders for the session. And instead, all of this stuff is actually down. So that's a little bit of a red flag. In terms of trade setups, if we drop it on down to the hourly chart, because of how important this level has been right here, I would keep a very open mind for lower highs under 179.75 to trigger a sell towards 175.50. I would actually look for that exact trade again tomorrow, right? If this wants to break down more respectfully, we open in range, Brigade bolt here, that's a possibility. The long is going to be over the 2-day high. Very, very easy long to spot over 184.85, back over the daily breakout level as well. Let's go on over to Microsoft. There's no comment here. This is in a junk drawer, as we call it. I really love that term. I don't know what it is about it, but the boredom box, the junk drawer, the range, the balance, whatever you want to call it, there's nothing to do here, right? It's either this or it's either this. Until proven otherwise, I wouldn't touch it with a 90-foot pole. Apple, it actually faded decently off of this low in here, that 251.35 level on the hourly chart. You could start to see this. You can see that fade here. But it's closed back above this double bottom low. So I'd be a little bit neutral in this box. I'd go back to bearish in this and then seek the bear flag breakdown for the remainder of the thin structure retracement over here. But until proven otherwise, kind of neutral in this segment, and then definitely just like no interest here. Reason being is the all-time high break is going to be interesting if it goes, rather than just getting chopped up in the range. The boredom box, the junk drawer. If we take a look at Amazon, 2 long-legged hammers off of the daily 200. The response here has been a little tricky. I thought that it was going to be a possible nice long setup before the end-of-day tweet from Trump about soybeans on Tuesday. Brigade bolt here would then complete sort of an inverted head and shoulders, recapturing the bottom end of the range, as well as the daily 200, but that's kind of out of play right now. So taking this step by step, I don't love it. I don't like the prospect of being short into the daily 200, and you can see why. I mean, each of these days, Tuesday and today's Wednesday session, you've not been rewarded for taking shorts into the daily 200. If anything, it's sort of blown back up in your face. rather than been lucrative. So I don't like Amazon. The chart's been a little bit hard to get follow through out of recently, so for that reason, I'm probably just going to pass on it. If I look at Google, this one is my this is my Achilles heel of the day. It was a trade that I had planned for. It was a trade that I had really been interested in here, but it almost became too hard to capture on the open there. There was not a beautiful, clean enough intraday setup to capture it, in my opinion. If you caught it, then again, all the power to you. Congrats, kudos. But this was the one that got away today. It also offered the same setup into the afternoon here, bouncing off of that 247. Nonetheless, beautiful trade come and gone. Next idea is that it needs to crack the 3 equal highs. If this is going to be some kind of double bottom, great. Next setup is over 251.25 for continuation over the daily 20 back up towards the all-time high. Keep it simple. Consolidation in here, really wide range. I'd let it balance, build out some consolidation, and then go over 251.25. If it drops this, I would be uninterested in this range here. Let's go to the metaverse. Not really interesting. A lot of these names are pretty tough spots. I mean, look at this on the daily. What are we going to do about that, right? You're not really trending cleanly. It's not quite a double bottom yet. You're under the daily 20. Just really, really rough chart. So I'd sort of just wait until some clarity, hopefully on earnings from some of these names as to whether or not they set up. Here's Tesla's junk drawer. Again, a doji smack in the middle of the range. Nothing to do with that. Let's take a look at, and when I say nothing to do with it, the implied trades are always this, right? If Tesla does this tomorrow and offers a nice trade over 444.50, I'm not going to be like, oh, I wasn't interested because it was just in the range. No, I'm going to be watching Tesla over the top end of the range. But for now, there's no big edge. There's no comment. It's the same chart it's been for weeks, right? So JPM, what's over here? Really ugly reversal, actually, off of the high there, post-earnings follow-up. So this bull flag thing is not really working. Ideally, buyers would have found acceptance over 310.75, and that's not the case. Sharp reversal into the afternoon. I would sort of keep an open mind for a big overshoot on earnings. Do we get a right shoulder? Do we ultimately get some kind of move over the neckline? TBD. A lot of the news was positive around these big banks. Investment banking is doing well. Trading activity is doing well. We'll see how it continues, but I wouldn't be aggressively bearish yet on banks, JPM. If we look at Palantir, another one, junk drawer, same implications as Tesla. When and if it does this, great. When and if it does this, great. For now, no comment. Let's jump into Broadcom. Trying, a frustrating chart with the breakdown on Tuesday, but trying. Does it hold over 347.65? That's the continued watch. Do we get some sympathy here to possibly TSM earnings tomorrow morning? Maybe. So I would watch this very closely. I'd watch the 2-day high at 358.70s. If we can get back over, looking for the all-time high, really, with respect to the 3-day high, 365.25. Next up, AMD. AMD had a little bit of a tear today, huh? 7.1%. Wow. High and tight consolidation looks pretty good. I would keep an open mind to AMD catching a bid if TSM continues to look real good tomorrow on earnings. As long as we don't produce a big gap down to open back under 226.65, great relative strength today. Will we get a day 2 follow-up to the upside? We know it's hot off the OpenAI Catalyst deal from back over here. So I'd continue to keep this one on watch. This looks a little bit more compelling to me than something like Broadcom, if I'm being quite honest. That's just based on purely the sort of structure and the momentum that is still interested in this, right? Simply put, people are interested in AMD. Look at the number of shares that traded today, right? That's huge. Let's go Robinhood. Robinhood looks weak, inside candle, closing under the daily 20. I think we still have thin structure to retrace to the downside. Origin of this breakout, 124.50, with respect to that prior high at 130. Here it is on the hourly. I would be very open-minded to Brigade bolts offering a setup under 133 for continuation to the downside. Again, 130, prior pivot high, but really thin structure here. Origin is at 124.50. Okay, if the market does this and supports, I would only be bullish on a recapture of this low, 138. Today's high, basically, on the hourly level. Okay, that is Robinhood. Those are your core list of companies. Those are the usual suspects. Let's get into some additional names. TSM, I just love the chart. I know earnings are going to throw a wrench in this, obviously, but look at how clean this is near the all-time highs. I'm just speculating here, and I'm not saying this has to be the case, obviously. If we, for some unknown reason, do not yield a big gap one way or another on TSM, if we just open in range here, I want to be all over the trade that's a breakout to blue sky territories over 306.70. I'm just very, very interested in that trade. Why TSM? Simply because it's the name that gets the business regardless of if you're AMD, regardless of if you're NVIDIA. They make the chips, right? They will be pumping them out, all these deals, 50,000 chips for OpenAI, this, that, the other thing. TSM, it doesn't matter. They're the ones who are going to get the business. So once again, I love the idea of TSM over that if there's no big gap up. Now, again, that's wishful thinking based on ASML. If we go look at that, on the, these guys make the lithography machines, gap fill reversal, but it did fade. It opened on a gap up, it faded, and then holding previous day's highs. So a little inverted head and shoulders. Wow. On the hourly chart, you could be bullish that, looking for upside lift back over the 1,000 handle. That's an idea on ASML, but TSM, just a chart for the ages here with momentum, volume. We'll see what earnings does for it tomorrow. Let's jump into the next idea, which is actually ASTS. Let's go with the space theme first. And you can see a beautiful pullback here after a range high break over 91.80. If I take a look at the hourly chart, you can see just beautiful bull flag consolidation. So really no issues structurally. Nice consolidation. If we take a look at the volume, notice how the volume was not, anything crazy. It was not an outlier. This is a nice little balanced day today. If we can Brigade bolt over 98.75 blue sky territories, let's rock and roll. Let's continue looking for some upside on these space themes. I would say ASTS looks better right now than Rocket Lab. Right, if you look at Rocket Lab, not quite as good. Look at this upper wick, overshoots the high, comes back in. Not quite as compelling over on Rocket Lab. All right, so ASTS is the place to be there. And then finally, a name I thought I would never really be into just because I didn't see it fitting the portfolio, but the opportunity is unmatched. HIMS. Take a look at this thing, breaking out of the daily balance range over here first on today's session on elevated volume ahead of earnings. The next thing, of course, is to monitor your weekly highs, which are about 10 points higher, so from 60 to 70. The weekly chart is just, it's quite a looker, if I'm being honest. If you can get a break up and over these highs, I think you might go for it on HIMS on an increase in volume. Now, you need to see that volume actually come into the stock, and maybe earnings is the catalyst that does it down the line. But for now, going back to the daily, pretty straightforward, right? Do we get something that looks like that, or do we just get straight up over the top end around 70? So let's do a little bit of chart work together here live in real time and just see what the numbers actually are. So 60 bucks is essentially the level. It's spot on the money. No problem with that. And then if we zoom back over to this pivot high, that is going to be up around 69.40. Perfect. I'll leave that at 40 cents. It does not have to be a round number. That will work for the sake of that upper wick. So a couple of things you could watch for. Brigade Bolt pullback over 60. Longs 69.40 is the target. Of course, with respect to today's high, you could come in here and do something that looks like this and just say something like 63.85. I'll round that one down a little bit. And we'll do that. And there we go. So this and this ideas, that should be a little bit deeper to 60. You get the idea. And then if it's just going to be momentum, oh my God, up and away, this is your next watch over 69.40 for continuation higher. All right. That is what I've got for you on HIMS, the healthcare sector. As we know, we just looked at the XLV. Let's just pull that up real quick. It's really a decent looking chart here too, right? Definitely falls into that category. So that is what I've got for you in today's episode of the Midweek Market Update. With all of this chaos in the market, hopefully, if anything, you remain respectful of your account risk and do not overlever in the volatility. You're able to weather the storm. You come out the other side stronger for it, learning some lessons from it, hopefully making some money from it. And as conditions normalize again, that's when it's back to the grindstone, rinse and repeat, usual stuff. The market keeps chugging along. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we will be live again tomorrow morning for another installation of the pre-market prep kicking off at 8 a.m. Eastern time as we typically do. We're live every morning for that. And I think with that, I wish you a green trading week. And as always, I'll see you in the next one.